It's even better with the mic. So you are investors. I'm an economist. So you must think another economist. So I asked myself, what should I tell them? I have to talk about investment. And I decided that I would present you, among all the investment themes I have been thinking about, we have been thinking about in my company, select three big investment themes. And by the way, since the crisis is behind us, and because I am not in the camp of double dippers, those who believe that the W is going to hurt us, I think it's time to take risks. So what are these three investment themes? First one, there was a very strange hybrid animal created during the last 12 years, which I call the first globalization age. Now we are entering into the second globalization age. It is China-America. US consumers buy Chinese goods. They pay Chinese workers who invest in US treasuries. You know the theory. This model has gone. And we need to think about the long-term consequences of breaking the hybrid China-America. My second theme, and Professor Padoan has already talked about it, but let me put it in a very blunt way. In our rich countries or old economies, we are going to deal with wartime debts in peacetime. 100% of GDP sounded Italian a few years ago. We are all becoming Italian, or maybe Japanese. That makes a big change in the composition of the global supply of assets. Much more government bonds, and the same amount of savings on the other side of the balance. There will be consequences on prices. And my third theme is the mirror image of the green growth Professor Padoan was talking about. That's the black side, play the carbon war. I will try to give you a couple of ideas about that. But before going into these three themes, since I'm an economist, I cannot resist the need to give you a couple of views. What you see on this chart is an illustration of the V-shaped recovery which is taking place. On the left-hand side, old economies. Europe, US, Japan, we are not different. We are all in the same basket. The fall in industrial production was 20%, the same as global trade. And there is a sharp recovery, believe me, right now. But when you start from such a low level, this recovery is very, very far from bridging the gap. Now, if you look at emerging Asia, industrial production, you have the same thing for GDP. Well, by the way, emerging Asia is a fig leaf to say China. Not only emerging Asia has already caught up with the level of early 2008, but has even caught up with its long-term trend. So as investors, take the lesson from these two charts. It's very simple. In this crisis, there is one winner, which is China. China has leapfrogged other economies in its long-term catch-up process. China has gained 4 years in this process. Let me insist a little bit, because we are in Europe, you are investing mostly in European assets, although not only. What is the outlook for Europe? I'm in the optimistic camp. I believe that when you have a synchronized monetary and fiscal policy reaction on a global basis, then the consequences on growth are more likely to surprise on the upside than on the downside. So I'm in the optimistic camp. I believe in a V-shaped recovery. I've made a simulation on German industrial production. That is the largest economy in Europe. That is the economy which was the most badly hit by the collapse of global trade. When Germany is ill, Europe is sick. When Germany recovers, it's good for Europe. So I've simulated a recovery like in 1995 after the first oil shock. Here is the simulation. If you are optimistic, the level of activity of early 2008 will not be seen before 2015. And the economy will not catch up with its long-term trend before 2012. Oh, by the way, the long-term trend was not what we saw in the years from 2005 to 2008, when the economy was overheating. That is a very important lesson. It has, of course, consequences for public finances. It's very difficult for government to cut costs, as you know, even more difficult than for a private company. But I want to talk about companies. When you understand that you will not reach the level of sales that you had in 2007 before 4 or 5 years, there is only two things that you must do. A, cut costs, and not during 6 months, but during several years. Because your cost basis is calibrated on the level of activity of 2007, which you will not see before several years. If you don't do that, you will go under. And the second thing is innovation. We have already talked a lot about innovation. That's the only way to gain market shares and beat your competitors. This is a very tough environment for European companies. The cost cutters, innovators, will be the winners. Let me insist again on innovation. The euro is going to remain extremely strong as a mirror image of the weakness of the US dollar. I will come back to this. How do you survive in that case? Cost cutting and innovation. So let me talk about this first theme, breaking up this strange animal called China America. So what was the model in the first globalization age that started basically after the Asian crisis, 1988? As I said, US consumers buy Chinese goods. That was the development policy chosen by China, by Deng Xiaoping. It has worked incredibly well. China has developed a very powerful manufacturing sector, totally export-oriented, and this has helped to take out of poverty maybe 500 million people. So this strategy was extremely successful. It looked like a win-win strategy, but it was funded by an excess leverage of US consumers, and now we are seeing the deleveraging of this model. The model is broke. My view is that in the medium to long term, the personal savings rate in the US will rise. We started almost from zero in terms of the personal savings rate in 2007. If you simulate the impact of the loss of wealth that US consumers had to go through, 12 trillion US dollars losses on property assets and financial assets. If you simulate the impact of this loss, you get a kind of equilibrium savings rate at 10% to 12%. Well, from 0 to 10 to 12%, there is a long way. So that is going to be one of the features, not of 2010, but of the next several years. US consumers are going to become savers. If you have lost your wealth, you need to save the good old way by taking from your income, which has a lot of consequences. The first one is that consumer spending will disappoint. That will not be the main driver of the recovery in the US, in my view. Second consequence, the US dollar will remain a very weak currency because you remove a part of the demand side of growth in the US with this rise in the savings rate. Third consequence, China has to change its model. If things worked so well for China, it was because there was this consumer of last resort. That was the US consumer. And China is perfectly aware of that. If you listen to what the Prime Minister Wen Jiabao says, this is perfectly understood in Beijing. He says we need to rebalance our growth model from the export side to the domestic side. How can we boost domestic demand? In China, the labor market is almost perfectly flexible, which means, by the way, that a revaluation of the currency would do nothing because wages would go down. So the idea is to develop a social safety net, social security, as we would call it in Europe. The Chinese are ready to spend 20% of their GDP to build this social safety net for 1.4 billion people. This is going to be a road with a lot of difficulties, but that is the political line in Beijing. I think it's better to position ourselves on this kind of trends than being skeptical about what the Chinese are going to do. Another consequence is that there will be smaller imbalances in this world, with a smaller current account deficit in the US and a smaller current account surplus in China. That is good for sustainable growth, but there is a price to pay. Global growth will be slower than it was before. In the 4 years before the crisis, global growth was running at almost 5% per annum. The long-term trend was 3.25% to 3.5%. We are going to be back in the long term to the good old 3 to 3.5%, which means, by the way, that the performance of some asset classes over the last 10 years should not be taken as a benchmark, because the next phase of globalization will be different. And since I'm talking a lot about China, and I alluded to the currency, let me tell you something that I heard when I was in China only 1 month ago. The Chinese set a target for Shanghai, I think that was 2 years ago. They said Shanghai in 2020 will be a world-class financial center, competing with New York and London. And when I was there in Shanghai, I understood that you have to take this goal quite seriously. They are going to do it. How can you have an international financial center if you do not open your capital account? The answer is it is impossible. So we know in advance that China will open its capital account and float its currency before 2020. Maybe it will come earlier than that. That makes for me investment in Chinese securities, and mostly government bonds, if you are really a buy and hold investor, probably the most profitable investment in the world. I would prefer that to gold. My second theme is wartime debts in peacetime. As I said, 100% of GDP is going to become very soon the norm. Well, this has a lot of consequences. The largest rises will be in the US and in the UK. I'm talking about the increase, not the absolute level, which means that in terms of the credit risk measured, for instance, by bond yields, these two countries among the large economies will normally suffer the most. Well, maybe this is where you will get some interesting yields. But there is an issue in Europe. The issue is the following. Germany and France decided to ditch the Stability Pact 5 years ago. You remember that. That was not officially said, but that was the strategy. Now Germany has decided that since the Stability Pact doesn't work, they will have their own rule, which is a balanced budget, or almost balanced budget, from 2016 and a balanced budget from 2020. There is a social and political consensus on that in Germany. It is now in the constitution. They will do it. And that creates some interesting issues for the fiscal strategies. Some people call that exit strategies for the other euro area economies. And since fiscal policies are dependent on elections, on who is ruling the country, that takes time. In the end, it's not possible to share the same currency if you have a diverging trend in terms of fiscal policy. I say in the end because nobody knows exactly when could be the end. But let me again be very honest with you. You cannot share the euro with a country which has decided to stabilize its debt if you don't take the same direction. So before we see the political decisions taken country per country, Greece is in the spotlight right now, as you know, we will have more differentiation between the sovereign bonds issued by the countries of the Eurozone, which is a good thing. There was a lack of market discipline in the years that followed the introduction of the euro. We might see some overshooting, sometimes caused by external events, such as the default of a company in the Middle East. But this is here to stay. That's my point. The markets will keep two things in mind. One, there is a liquidity premium that was not correctly priced before the crisis, even for government bonds. Second, fiscal strategies have to be assessed on a permanent basis. And I think that is a good thing for us, investors. You will find higher yields in this class of assets, which has a very low cost of capital for regulatory reasons. It is government bonds of the euro area. And in my view, the frontier between investment-grade corporate bonds and sovereign bonds will not be as clear-cut as it was before. So if you can have the same yield with a government debt, with a sovereign debt, well, why not taking this opportunity? I have to say a word about inflation, because this is something that has become a kind of mainstream story. When governments have unsustainable debt, generally they do not have the courage to do what has to be done, which is to raise taxes, to cut spending, in order to stabilize the debt. So they use inflation as a kind of stealth tax, the inflation tax. This theory is relatively popular in the US, and some hedge funds are selling products based on the idea that when the government accumulates a debt above 100% of GDP, and at the same time the central bank is issuing a lot of currency, which is not true by the way, this will end into hyperinflation. Well, let me take exception with this view. Hyperinflation is a fantasy. I leave it to the scaremongers. We might have slightly higher inflation in the US, 3 to 5%, maybe slightly more, is a distinct possibility associated with the weakness of the US dollar. Don't count on high inflation in Europe. There is a COP in Frankfurt named ECB, which will not allow that. And for those who believe that history is giving the proof that governments use inflation to kill the debt, look at the most important story of the post-Second World War history. It's the US case. Europe was destroyed by the Second World War. So we cannot take Europe as an example. It is true that there was inflation after the Second World War, but starting from an initial situation which was totally abnormal. The US case is more interesting because there were no distractions by definition in the US, and GDP growth was very strong during the Second World War, precisely to win the war. The federal debt was 122% of GDP in 1945. 10 years later, it was only 60% of GDP. How was that done? I've made the calculation. Average GDP growth in volume terms was 3.6%. That was the main contributor to the reduction of growth. If your economy becomes bigger, the stock of debt is the same, so of course the ratio goes down. The second factor was inflation. On average, 3.3%. That helps. But don't tell me that 3.3% is hyperinflation, or the words have absolutely no meaning. And fiscal policy did a good part of the job. That is the third factor. I'm not saying that we are going to follow the same way. 3.6% GDP growth is out of reach for the US, Europe, or Japan. What I'm saying is that history does not tell us that inflation is unavoidable in that case. My last theme is carbon. We are a few days before the Copenhagen summit. I'm not a political analyst. I'm told that we will be disappointed, maybe, maybe not. But I'm sure of one thing. The idea that we need to decarbonize our economies is becoming global. Recently, we have seen Brazil and China moving on this front. And the reason is relatively simple. Because everybody is starting to see the consequences of climate change, by the way, whatever is the reason. So the populations are starting to back the idea that we need to do something. So whatever is the result of Copenhagen, my take is that we will have more and more carbon markets. The cap and trade systems, you might have doubts about them, but they are likely to become more or less generalized. If it's not cap and trade, it will be carbon taxes. If it's not carbon taxes, it will be carbon permits. A whole market is going to develop, and I don't know how to measure its potential. I think it is quite big. And of course, it has consequences on a lot of derivatives. I know that for the time being, derivative is a kind of dirty word, but believe me, we need derivative products. There will be hedging strategies on carbon, and we will use derivative products. There is a whole new class of assets associated with what I call the carbon war. More importantly, the smart people, whether they are policymakers or companies, will invest in low carbon technologies, mostly for energy production, but also for energy distribution, and a lot of other industries, energy being the prominent one. As Professor Badoan said, in the Obama package, a lot of money is going to hard science, $50 billion US for pure scientists, mathematicians, geneticists. They could not believe what was happening when they read that in the newspapers. It's around $250 billion which are going to science, technology, innovation, and this is gravitating around the theme of energy and biotechnologies because of the need to finance the healthcare reform. Other countries are investing also massively. You mentioned Korea. That was quite interesting. I was in Korea a few weeks ago. In Korea, there is a tokamak, this technology invented by the Russians to simulate fusion. You know, we have this device which is being built in France, ITER, that is fusion technology. The Koreans were the first to have a small tokamak working, and it is a kind of experiment that is going to be used in ITER, the international project. When you see that people are able to innovate like that, you think, okay, they are taking some advance. So my point is the following. The competition will not be between China and the US on low carbon technologies. The competition will be between the US, Japan, and Europe, where we have the research capabilities. Some will be winners, some will be losers, but we know who will be the buyers of technology. China, India, and those future giants of the global economy, including South America. So, in terms of suppliers, it's competition between governments, between companies. The buyers, we know them. Who is going to invest? Because, of course, there will be a lot of private investment going into this effort. My guess, it's not a scientific one, but it's my guess, is that the sovereign wealth funds will be among the biggest players to invest in low carbon technologies. Middle East, Asia, Norway, they are already investing in these kind of technologies. If you think of it, if you produce oil, which is the case for Norway and for the Middle East, you are long oil by definition because it is under your feet. So if you want to diversify your assets, it might be smart to invest in non-oil technologies. This is precisely what they are going to do. And that also tells me a third thing, or fourth, I don't remember. Responsible investment, which is still a relatively marginal theme in the investment community, will become mainstream. And it is definitely the theme of climate change that will take the prominent place in responsible investment. As soon as you will start to see the big sovereign wealth funds, the guys who have 500 to $1 trillion US to invest in, taking a view on responsible investment, you will see that it will become mainstream very quickly. My conclusion, it's time to take risks. Don't be too much impressed by the fat tails. The fat tail risk, the non-Gaussian distribution for mathematicians, is behind us. It's time to take risks. Thank you.